to address you on the global financial crisis, African Central Bank's response. There will be a paper and there is a PowerPoint presentation, which I don't know why they do this because I never use them. Usually the paper is for distribution, and I make sure there's always a paper so that when I say the wrong things, I can refer to the paper as evidence that I was quoted out of context. I've been told that this is the closest I'm going to get to a novel lecture, and therefore I've come quite prepared in terms of the documentation. And I'd like to say, just for clarification, I did find the timing auspicious because yesterday there was a big game here that I thought we were going to win. Unfortunately, Arsenal lost. So if at any point in time you get the sense that you're listening to a miserable person, it is because you're listening to a miserable person. Now, perhaps the best place to begin this talk is to go over a few weeks ago when I received an interesting invitation from the Royal Amsterdam Foundation. And the Queen had this annual symposium. And I was invited to speak along with Justin Ling, the Chief Economist of the World Bank, and Mr. Martin Wolf of the FT. But what I found interesting was they wanted me to speak on what Europe could learn from Africa's handling of the crisis. And I thought it was interesting because they did say that Europe is looking at other parts of the world and basically asking how central banks responded to this crisis. And perhaps there is, for once, something that we can share in terms of our experience coming out of 2007-2008. So what I would like to do, and most of what I will say, not all of it, you'll probably find in the papers, and I do hope we can revise the papers later to capture whatever it is that goes into the lecture that's not in the paper. What I would like to do is begin by talking about how the crisis affected my country, Nigeria, and it did affect our country in a far more significant way than other African countries, how we responded to it, and how it provided for us an opportunity, not just for redefining the structure of the Nigerian banking system, but developing new strategies for preparing the economy to cope with any second rounds of this type of crisis. Now, the global crisis of 2007-2008 started, and Africa was at the beginning almost totally isolated from it because of the decoupling, because of the lack of integration of African banks, African financial systems with the international financial system. So we did not have any first round impact hit us. Nigeria was hit by the second round effects through two principal channels. One was the commodity price channel. What happened to oil prices? As you recall, in 2006, at the height of the bubble, oil prices had gone as high as $147 a barrel. At some point in 2009, oil prices had crashed to less than $40 a barrel. And as is usual in resource-rich countries, there was always a very strong correlation between commodity prices and financial market asset prices. And we did have a stock exchange that at the time the oil price was at 147 in 2007 was the world's best performing stock exchange. In 2009 it was the world's worst performing stock exchange. And the simple reason, of course, is that every time oil price went up, we sold the oil, we monetized the revenues, the money found its way to the balance sheet of banks, and from the balance sheet of banks into the capital market, and the bubble then built locally. So when oil price crashed, and at the same time we had a Niger Delta crisis with output crashing, there was a major collapse in government revenues and liquidity in the system, and the stock market also crashed. Now, it became very clear from 2008 onwards that there were major problems. On the macroeconomic side, the central bank had to devalue the naira by about 25% in order to protect reserves because of the capital flight. And we had to adopt the usual measures of central banks, making adjustments to cash reserve requirements, liquidity ratio requirements, had an expanded discount window allowing banks to borrow against an expanded class of assets. But these, as we have seen in Europe, just address symptoms of a crisis. If banks need capital, they need capital. If you don't put in capital, any kind of liquidity measure has to be temporary. So by 2009, when I became governor, it was very clear that a significant part of the Nigerian banking industry was on the brink of collapse. And if it did collapse, it would have brought down the industry as a whole. And it was also clear that the sources of crisis were two. One was significant exposure to the capital market, with banks lending huge amounts of money to stockbrokers and asset management companies, and also taking depositors' funds and trading on their own account, basically speculating and taking advantage of the bubble, much like the banks in Europe did, basically high leverage with huge concentrations to a particular asset class. The second source was exposure to petroleum marketers who have been in the news recently over the fuel subsidy removal. And I'm sure it's something that may come up in the Q&A. But basically, if there are any Nigerians with shoes, please warn me before you throw them. And those two sectors basically accounted for the huge levels of non-performing loans to the banks. So what I would like to do in the first part of my talk for the next 10-15 minutes is basically say, how did we approach this problem? And then what have we done after to prepare the system for coping, for what we see as potential challenges coming out of Europe and now coming out of possibly China, India, Brazil, who were the major engines for growth at the last time, and who may not provide that engine in the event of a double-dip recession. The first thing, of course, was to try to identify the problem. And we sent in teams of examiners to look very closely at the banks and their portfolios. And we discovered to our horror that the problem was much worse than we thought it was from outside. That 8 banks were in a grave situation, and these banks, out of the 24, accounted for 30% of total liabilities and 40% of total assets in the industry. And in each of these cases, what was apparent at the beginning was that the banks had basically taken depositors' funds and were trading largely on their own shares. There was one bank that owned 25% of itself, those subsidiaries. And others had basically lent money irresponsibly to stockbrokers. The share price was going up. As we know, the stock market is driven by what they call the biggest fool theory. You buy a share for £10 and hope that the bigger fool will buy for £12. And he buys for 12, looking for the bigger fool to buy at 15. Until the biggest fool buys at 20, and he can't find anyone to buy after that. And then it starts coming back down. And so we had so many of the biggest fools in the banking industry. And they were left holding the shares when the stock market started going down. And unfortunately, they were not buying those shares from their savings. They were buying the shares from depositors' funds, from the savings of Nigerians who put the money in the banks. Now, the history of Nigerian banking crisis did not start in 2008. We've had several crises in the past. And what's always happened in the past is these risks are taken, the banks go under, they're handed over to the National Deposit Insurance Corporation, the NDIC,